technical analysis. Stock price charts depict past and current price action in a useful, easier-to-discern format. However, a stock's price isn't based on its past performance as recorded by chart. Its current price is the market's majority, subjective estimation of future value. Whatever trend we infer from today's chart indicators or patterns may or may not persist tomorrow, or price in uncertain market. We'll move on investor sentiment to tomorrow's information and news, sentiment often seeming contrary to the news itself. In the medium and short term in particular, price tends to take a random walk. We have short-term expiration, money on the line, and we'll want a crystal ball on how a trade we're considering placing might go. But we can't put too much credence on extrapolating past stock price action into the future, because today's chart or indicator trend can as easily reverse tomorrow as any other day. Chart patterns. Identifiable patterns do often appear, but numerous studies have shown that trading against patterns doesn't win consistently enough to profit over the long term. We're wired to look for patterns. It's human nature to look for patterns in things. We're uncomfortable with chance and unpredictability. As investors, we want to think we could have some predictive insight into future price movement, but we don't. We're prone to interpretation and confirmation bias in what we see, because our brains like narratives that confirm a pre-existing opinion. Different investors will interpret the same chart or pattern in different ways and derive differing opinions, because charting is far from an exact science. There's no edge in being arcane or complex in reading price charts. Indicators. Using any technical indicator or combination of, just to guess the next day's market index close, either up or down, tested over a period of 3 to 6 months, ends up around 50% accuracy, so it could justifiably be claimed that technical indicators have no statistical advantage over coin tossing. However, we can look at indicators as a means to make a guess at where a trend may look more likely to at some point begin or end. For instance, RSI will at some point revert from overbought or oversold. Using a number of indicators will either conflict or be confirming the same thing. One or two simple indicators that might sometimes help to gauge the strength, weakness, direction of a trend is enough. Volume. Trading day volume when compared to average volume gives an indication of how strong or weak the momentum of a rising or falling price trend may be. Support and resistance. Stock price chart support and resistance levels from previous supply. Demand price consolidations, reinforced by the weight of many investors following and trading against those levels, do have significant repeatability, so as to be able to base quite sound opinions on where price may more likely settle, price points where we'd feel more comfortable to set our strike prices. It's best if cash-secured put strikes, written 10 to 20% OTM, are also at or near prior support levels. Similarly, we can look at resistance levels when writing covered calls against a call strike lower than the equivalent assigned put strike, when using an adjustment strategy, or when betting for intrinsic stock price gains at a higher than equivalent call strike. For our strategy, we don't have to pick tops and bottoms, which is impossible to do with any consistency. We're aiming to make the best, near enough guess of the most likely level a stock's price might consolidate near or the levels that price tends to range between.